Hi, this is Nick Papanicolaou, VP of Brand and Business Development for New Brand Ventures at Pernod Ricard USA. And I want to continue the valuation discussion with Valuation 301 today. So I talked earlier in the first and second session a bit about the different methodologies. I just want to clarify something, which is what our expectations as a corporate or strategic or investor are of you, the entrepreneur or brand owner, is really to know your business inside out. All of the valuation methodologies we've discussed are either kind of well known in the marketplace, or an investment banker or a placement agent or consultant will know those. So we're not expecting you necessarily to know those. We'd expect you to know your own financial statements, your own numbers, so we can then apply those valuation methodologies or those multiples to your own financial statements, essentially. And we obviously know those numbers or those multiples and methodologies. And as I said, investment bankers and independent consultants often know them as well. So hopefully that helps explain a little bit on what our expectations are of you as we discuss an investment or a partnership. Now, I wanted to kind of close the valuation discussion by saying that those are just three methodologies, and they are all what's called income statement, essentially, methodologies, because they're based on your own income statement, your own earnings. We would also expect you to know your balance sheet, and we would look at your balance sheet as a potential investor, because there are very interesting cases, and this is why valuation to me is a triangulation of methodologies and not anchoring just on one multiple or one methodology. There are cases when a multiple of sales, so for instance, a brand could have $1 million in sales, and let's just say you use a 5 times sales multiple. That means the valuation of that company is $5 million. However, they could have laid down inventory that's worth $10 million. This is all hypothetical. Why would an entrepreneur that has $10 million of assets want to sell his company or raise money at a $5 million valuation? So this is why it's too singular to look just at income statement multiples, and you need to understand the balance sheet as well. And inventory, of course, goes on the balance sheet, as do other things like the actual distillery, property, plant, and equipment. The value of the distillery could have a lot of value, and that could be in excess of the valuation based on sales. So there are many other kind of methodologies based on balance sheet. Liquidation valuations, what's called replacement cost valuations, mark-to-market valuations, that all can be coupled with some of the income statement valuations we talked about earlier to help you triangulate what a fair valuation could be. So I hope that helps explain more how this is really an art and not a science, and it really depends on each brand's unique situation to help determine what valuation is appropriate. The final point I want to make is that beauty is in the eye of the beholder. Same with valuation. Something to a financial investor might have a very different valuation than to a strategic. And of course, even within the landscape of strategic investors, one might have the need to buy an American whiskey much more than another does, and therefore the value of that proposition or target might have a much higher valuation than it would to another potential buyer. So again, lots of factors that go into it, but hope this gives a pretty good primer on valuation. Thanks so much.